Hi, everyone, and thank you for joining us for the webinar today, Unlocking Hidden Tax Savings, specifically focused on mastering tax credits and incentives for government contractors. Give me one moment while I make sure I have my screen shared appropriately, and then we'll continue. Excellent. Okay. With that said, I really want to thank Deltek for being a sponsor of today's webinar. Cherry Bekaert is a Deltek partner offering solutions centered on their cost point platform, which helps government contractors with three-dimensional accounting, contract management, real-time project management, and other important tasks. Deltek has served as a leading ERP solution for government contracting accounting for more than 30 years. We're going to be collecting responses today as we ask some polling questions. But please note as well that this is a non-CPE session. So with that said, I am thrilled to introduce the additional speakers we have today, one being Vivian Kors, who is a director in our Tax Credits Incentives Advisory, and the other is Tim Doran. Real quickly, I'll introduce myself, and then I'll have them speak. My name is Marty Cameron. I'm the head of our Credits and Incentives group at Cherry Bekaert. We are a group of about 40 plus dedicated to credits incentives on everything from research and development tax credits, capitalization for R&D, cost segregation studies in the real estate area, also energy efficiency studies, and also Inflation Reduction Act type incentives as well. We're going to focus today on really two things that are, I think, very relevant to government contractors, one in the R&D space, and the other, I think, one of the more exciting developments in and around the Inflation Reduction Act. With that said, why don't we take a moment? Vivian, why don't you introduce yourself, and Tim as well, and then we'll move on.
Hey everybody, my name is Vivian. I'm a director and I work very closely with Marty. I specialize in research tax credits as well as R&D capitalization, and I've been doing it for more years than I'd like to admit, but you can't tell.
Okay, so I want to focus on the following today. This is just the overall agenda. Again, we are very government contractor focused today in our thoughts. There's quite a bit going on in the credits and incentives world due to post-election, we'll call it campaign rhetoric combined with post-election expectations or speculation. But I want to talk a little bit about Cherry Bekaert, what our process is for anybody who may be interested on the call to talk to us about how we take advantage of, or at least analyze credits and incentives in the government contracting world. We're going to talk a lot about the research credit, a little bit of its history at the basics, but also some of what's happening around it and really how some of the recent guidance affects government contractors probably more than any other area with which we deal. We're going to talk about the capitalization around that too, and whether that may stick around or not, but we have to deal with it anyway right now. Tim is going to talk then about Inflation Reduction Act, specifically energy credits and incentives. We're going to talk a bit about what incentives change, what's changing for 25, but then also the way that these credits are now saleable and you can purchase them on an open marketplace. So if there's any C corporations out there who are government contractors, there's the possibility to purchase tax credits and incentives. And then at the end, we're just going to cover a little bit on cost segregation and some of the enhancements to the energy efficient commercial building deduction for anyone who's either purchased or made a refurb to a building. Okay, with that said, I'm going to talk a little bit now about Cherry Bekaert and our strategic tax advisory annual review, which we call it, if we can do it annually. But with that said, Tax Credits Incentives Advisory Group is one of 4 specialty tax groups within what's known as strategic tax at Cherry Bekaert. We are focused today on everything from international to tax credit incentives to state and local to strategic financing. What we like to do beyond just some of the smaller topics we'll talk about today or the more focused topics is have the opportunity to, on a complementary basis for the most part, work with you to look at what may be driving tax up or down and what we can do to maximize or optimize your tax planning. So we are focused beyond in our strategic tax review of just beyond credits and incentives, but focus more on every strategic tax offering that we have. Again, where we're focused is on things like R&D. We can focus on payroll tax issues. A lot of these are triggers that create opportunities like job creation, putting up a new building, operating internationally or planning to, needing project financing, looking to expand and add jobs somewhere and have a capital plan going forward. All these things sort of go into what may be available for you. And so we're focused on that and would love to have the opportunity to work with you. Again, different phases. As we do that, we're focused on just understanding your company. We would then come back to you and quantify what the different opportunities may be, almost provide you with a menu of what makes sense in a particular year. Also, keeping in mind what changes may be happening on the horizon with respect to tax. As well, we will then get into a project with your permission and then come back with deliverables to develop and provide specific tax incentives that you can put on the return and capture them that way with all the appropriate documentation. All right, just a little bit about our group. Tax Credits Incentives Advisory that Vivian and I and Tim are all a part of. We are focused on companies that are investing in R&D or performing R&D activities. If you're purchasing or refurbing commercial real estate, investing in alternative energy, renewable technologies, or just looking for a new site and creating new jobs, we're just adding jobs somewhere as well. We're focused on all these drivers, and then we kind of match up what the particular tax incentive is around that. Again, we're going to focus today primarily on R&D and Inflation Reduction Act opportunities because I think it's most relevant to you. And to do all this would be a whole day. But I think we want to provide a little value to you and give you something to focus on and take away at the end of the year as you focus on what's been happening this year and what may happen next year, because I think it'll be very important for your overall tax planning. With that said, we have a polling question. Has your organization ever undergone a strategic tax review? That would be yes, no, or I don't know. Again, our strategic tax reviews are focused and working closely with whomever your overall tax compliance person may be, but focused on some of the enhancers, what may be driving from a sales and use tax perspective, from an income franchise tax perspective, from credits and incentives to overall financing, and to where you may be going from an international perspective. So yes, 27% have, no, 60% have, and I don't know is 4. So with that said, again, I think these things are good to do year over year. And with that said, why don't we move on a bit? And Vivian and I will start to talk a little bit about R&D. I think I'll start to get into this slide, and I believe she'll then take over, and I'm sure the presentation will get better at that point. We have some hot topics here in the R&D world. The first is, and probably the hottest topic going these days in the tax world, if there is such a thing, is whether or not expenditures specific to research and experimentation need to be capitalized or can be currently deducted. Beginning back in 22, as part of the original Tax Cuts and Jobs Act, which was passed in 2017, companies began to have to were no longer able to currently deduct expenses specific to research and experimentation. Instead, they had to capitalize them and then amortize them over either 5 years or 15 years, whether they're domestic or foreign. There's been a lot of talk about whether this would stay, and so there's been a lot of uncertainty for companies about whether they would adopt this change in accounting method. And some waited, some then adopted it. I've kind of seen over time that we've had companies finally accept that it is a reality, it is the law. And now, as we move into a new administration, there's talk that it may again go back to, at least for domestic, being you may be able to currently expense it. So there's so much uncertainty year over year when these administrations change and the different priorities, and it seems like oftentimes your business may be captive to some of those politics right now. So our job is to sort of help you minimize capitalization, maximize credits that go along with that. And then under here, it talks about disclosure requirements. There have been some enhanced disclosure requirements that have been required for amended returns and may also be kicking in, or will be kicking in 2025 for currently filed returns. So if you're looking to claim credits, there's much more to sort of reveal to the IRS at the outset, as opposed to just putting numbers on a return. For startup businesses, one of the hottest topics, and that was enhanced in the Inflation Reduction Act, is the ability for companies that don't have an income tax liability to instead take calculated research credit and utilize it against payroll tax. So if they have employees that can be highly valuable, a way to monetize, you can use it against your payroll taxes in the quarter beginning after the one in which you actually file your income tax return. So there's some planning there about when that makes sense. You can do up to 500,000 of R&D credit that you can then basically elect to trade and use it against payroll tax instead. And again, we have internal debates and discussions with our clients about when it makes sense to look at R&D, considering that you may not be able to use credits. I think now is always the time to do it. There's these capitalization requirements that are mandatory. There's a potential to not miss out on utilizing the credits against payroll tax, which has to be done on a timely basis. And there's also the requirement to, well, not a requirement, but I think a strategic planning to make sure that you are calculating the credit under the method that benefits you the most, because there are two different methods of calculating it. And if you wait too long, you may be stuck on the one that doesn't benefit you. Okay, and then last thing, I see a lot of companies moving away from contingent fee providers in this space due to the enhanced requirements for documentation, but also it's hard for a contingent fee provider to say, here's your value for a credit, when also your capitalization that was required kind of goes hand in hand, that increases your taxable income. The point for us is to work to reduce that capitalization and increase its credits, but work on a more, I would say, fair and reasonable time and materials basis after we scope what those benefits are and what they're available to you. Again, high level, the credit, the R&D credit, as it's colloquially known, actually known as the credit for increasing research activities. It's a general business credit. It is a dollar reduction of the tax liability calculated. It does carry forward for 20 years. When we talk about these Inflation Reduction Act credits, we're going to talk about the ability for them to carry forward 22 years and carry them back 3 years. So that's a differentiation there. And I think that carryback is quite powerful. Finally, I think most important, not most important, but finally on this particular side, in the private equity context, portfolio companies generally don't have to assess whether they're eligible for the research credit by looking at all the other portcos that are owned by a fund. They can look at them separate business by business, which has been something that I think was at least a question a number of years ago, but I think we've clarified that. For both this, it also applied in the employee retention credit context as well. All right. Okay. I think we'll move on to the basics here. And with that, I'll have Viv probably talk slower, better, and take it away. Thank you.
Oh, thank you, Marty. Well, big picture wise, a lot of people, when they think of R&D, they think of, hey, I'm wearing a white lab coat, I'm here curing cancer or trying to fly to the moon. That is not what the government intended when they set out for this credit. What they were trying to do is incentivize companies to hire smart people to do work in the United States, and increasing research, right? So in order to qualify for the credit, your activities and the costs associated with said activities must meet this 4-part test that we see. So all 4 boxes have to be met. First test is permitted purpose, which is basically saying at the outset of the project, we were trying to improve or develop new functionality, performance, reliability, and or quality of the product. So in the IRAD sense, right, it could be, hey, we're trying to develop this net new product that can help help improve our defenses. Or in a CRAD context, it could be, hey, we were getting paid to help the government develop a new system that they previously didn't have, or improve upon the archaic system that the government originally had, is so that we could serve more people, or that the downtime is less, things along those lines. That would all kind of meet the first part of the test. The second part of the test is essentially saying the activities must rely upon a hard science, as opposed to soft sciences like social sciences and things along those natures. But hard sciences mainly around like engineering, physical science, biology, or chemistry, computer science, as well as chemistry and things along those natures. And then the last 2 tests are, I would say, the most gray areas and where the IRS focuses the most on. So elimination of uncertainty is saying at the outset of the project, there has to be technical uncertainty as it relates to the capability, method, or design of the product. So capability is, hey, this is a novel, this is a brand new novel thing. We don't know if we can get this to do X, Y, Z. Method is, we knew we could eventually get there, but we weren't sure what the best way was to go about developing the product. And then lastly, we weren't sure what the optimal design of the product was in order for it to be most performant. Then through a process of experimentation, which is the last test, the team evaluated more than one alternative to try to resolve the technical uncertainty. You didn't have to have succeeded in resolving your uncertainty, but you have to have tried. And I would definitely want to highlight the difference between a business uncertainty and a technical uncertainty. So business uncertainty would be, hey, we didn't know if we could get the right JavaScript coders, or Business uncertainty would be, hey, we didn't know if the market wanted this. But technical uncertainty would be, hey, we didn't know what the optimal way was to design our architecture in order for this to be most secure, or we weren't sure what the optimal requirements were in order for us to develop a product that delivered this need. So that would be kind of the four-part test that all activities must meet. So as you would see, it's actually quite broad in terms of industries, and it is intended to be that way because the government didn't want to just specifically pick, hey, only the tech industry could qualify for this, or only the manufacturing industry could qualify for this. So it is broad, and it is intended to be broad. Next, we can kind of jump to what types of costs qualify for the R&D tax credit. So generally, I would say there's three categories of costs. What we see, especially in the government industry, government contracting industry, would be around resource costs. So that would be your W-2 Box 1 wages, as well as your third-party vendors, where you maintain the rights and risks to development. So those two types of costs would qualify for the R&D credit to the extent the activities that are performed by the folks doing the R&D would qualify. And then lastly, supply costs. So this could be materials that are used in development. Another big chunk of cost would be anything around prototyping. So say you're building a fighter jet, right? That could be a prototype, and all the costs associated going into that prototype could qualify for the credit. And then lastly, if you're in the software development world, or maybe even in the testing world, you are using any cloud hosting expenses, like your AWS's, your Microsoft Azure, Google Cloud spend, that would all be, to the extent standing up dev environments, would be qualified research expenses. And in short, we're going to refer that kind of as QREs. So I apologize in advance if I keep going back to QREs. That's what I will be talking about. So when we look at our process, as kind of Marty mentioned beforehand, is we complementary scope so that we can tell you if the juice is worth squeezing. Because if your R&D spend ends up not being as much as you think because of different facts and circumstances, we would tell you, hey, scrap it, don't pay us, it's not worth it, don't pursue it. So when we look and evaluate your qualifying research expenses, these are typical data points that we ask for. And what we do see a lot of times, especially in the Deltek world, is that the Deltek time tracking system does provide a lot of the key data points that would be helpful in determining kind of how much time each individual spends on qualifying research activities that would then everything be used to calculate your qualifying research expenses. So the Deltek time tracking system allows you to break out projects, initiatives, tasks, sometimes even by activities. And what we are seeing in the trend of the IRS exams is they are trying to look for, and they're trying to ask for more and more time tracking data. Not that it's required, you don't have to have time tracking data in order to qualify for the credit, but the IRS is looking for, hey, how can you prove that you're contemporaneously, like your time that you're spent is contemporaneously documented? And one of the most comprehensive ways would be using a time tracking system. So, and then the contracts, that's going to be a huge part, especially in the government contractor world, that we will discuss later on. But there's a concept of funded research, which doesn't qualify for the credit. And again, it's going to go back to when we evaluate your activities and your work for each of your contracts, we look at the four corners of the contract to see whether or not you bear the financial risks and the development rights so that you can qualify for the credit. As Marty mentioned earlier, there are two ways to calculate your credit. And when we look at it, we look at both ways in order to make sure we're picking the way each year, what makes the most sense for your company to maximize the credit. So there's a traditional method, which looks at more of your gross receipts. And then there's an alternative simplified credit, which really looks at your average qualifying research expenses in the prior 3 years to calculate your base. But both methods are looking for increasing research, which again is what the government was trying to do when they set this up, is to incentivize increasing spend in R&D in the United States.
Right. Question number 2. Do you have an R&D study performed every year? We work with a lot of companies that have been doing it themselves or found that they didn't need to have it done or didn't think they needed to have it done due to the fact that they didn't have a current tax liability. But in our experience with these capitalization requirements, which we're just going to get into right now, under what's known as Section 174, the best way to minimize that capitalization to the extent you care is to actually have some amount of study on the potential credits available, because you can, through that, develop tools to allow you to reasonably lower that capitalization. So yes and no, and that can be for a variety of reasons. But we appreciate that response, and we'll continue now.
I do find it shocking that nobody does it in-house. That's a good answer. It's hard.
Yeah,
R&D tax credits
yeah,
are hard. Um,
absolutely.
so with that said, wanted to jump into more, I guess, nuances within the government contracting world. So like I mentioned earlier, there are different contract types that government contractors generally enter into. Sometimes now it's like OTAs that we're seeing more and more of. But when we look at your R&D costs and whether or not it qualifies for the R&D credit, we look at financial risks, who bears the financial risks, and who bears the development or who retains the development substantial rights. So, for example, when we look at FFPs or fixed price contracts, generally, I would say, generally, again, it really depends on the contractual language. Generally, the government contractors that's getting paid to do the R&D would retain the financial risks because there would be maybe acceptance clauses or milestone payments where maybe sometimes even clawback clauses where the government contractor won't get paid unless there's a successful deliverable. Um, in the cost plus and time and materials world, and again, I say generally, right, because it really depends on each contract. I would say the government bears more of the financial risks because you're reimbursed. And there are actually a lot of case law in the early 2000s that also showcases for government contractors which types of contracts would show that the government contractor bears the financial risks. I do want to note that in the world of R&D, we currently are talking about R&D credits, but later on we're going to jump into R&D capitalization, which is what Marty mentioned earlier in terms of the requirement to capitalize your R&D expenses for tax purposes. The difference there in terms of government contracts is for capitalization, you either bear the risks or you retain rights to the development. That would trigger you to capitalize. That would trigger you for the requirement to capitalize, which means it's much broader. So say you have a T&M contract where you retain some of the rights, right? Because sometimes the government doesn't care to have the rights, so they let the contractors retain the rights. You actually would have to capitalize for 174 purposes, but you actually don't end up with the credit. So that's just something to keep in mind of as you are negotiating new contracts, is to make it more beneficial for yourself. And it could be different to different goals, right? I would never say, hey, let tax planning be the main reason you're negotiating this contract XYZ. But have tax folks be involved so that the downstream impacts to tax payments are considered. And if it doesn't matter how the contracts are set up, make it more beneficial for you in the tax world. So that's something to think about in the government contractor space. And next we have kind of data availability, and kind of talked about this already in the earlier slides. But what we do see is if there's project codes, tasks, activities, those are all great fields to have. And if you are in process of setting up your Deltek time tracking systems or thinking of improving it, need recommendations, reach out. We'd be happy to talk to you to kind of see how we can help you improve your time tracking system so that you can more easily grab the data that you need for R&D tax credits. Next, we are going to jump to disclosures for amended tax returns. So I want to highlight this only applies to the extent that you're amending your returns for a refund claim related to R&D tax credits. So very specific, I would say. but it requires additional information that needs to be in the form of a disclosure statement that gets attached to your amended return that you would have to file with your refund claim. So it's asking for, hey, what are all the business components, which are really just projects that you guys are undertaking during that tax year, and all the research activities that are performed. So what the IRS did take out is they no longer require the names of the individuals who are performing the research activity, which I thought was very nice, because that was honestly getting our disclosure statements to the 30 and 40 page range. So that was a nice burden to not have anymore. And there's a 45-day letter that the IRS could issue to taxpayers to correct the claim if they feel like you don't have sufficient information. That 45-day letter is helpful to taxpayers because it allows taxpayers a chance to perfect that claim versus just outright rejecting the refund claim and having to go through the whole refund process again. But again, that's a very specific and niche area only for amended tax returns that are claiming a R&D refund claim. So it is complicated, and if there is a sufficient credit to go back and grab those years, let us know. We'd be happy to kind of look at it and see if it's worthwhile.
Yeah, I think the most important thing in this particular context, we're talking about those that haven't filed before, right? There may be a number of them who replied, no, we don't do it. And that's because they haven't had time to get to it yet. So this will be required. This 45-day letter that Vivian referenced is very important. And actually, since I wrote these slides a couple of weeks ago, they changed the rule and expanded it. So they'll continue to issue these 45 letters through January 2026. It was going away, and they're lessening that burden again. So every time they come out with something like to increase the burden, they understand that it is a burden on taxpayers, and they're trying to wean us onto that process.
Speaking of more burdens, right? So there's proposed changes to the Form 6765, which is the tax form that you would use to claim the R&D tax credit. So back in the day, or not back in the day, currently, it is just a quantitative reporting. So basically, it's just all these numbers that we would calculate in terms of what qualifying research expenses are, what your prior year qualifying research expenses are that generated XYZ credit. It's all numbers. What the disclosure requirements that are coming out for tax years after 2024, so starting your 2025 tax years, is more qualitative information. And it's on trend because that it's very similar to the disclosure requirements for a refund claim, in that the IRS is looking for more timely information on qualitative details around your R&D. So they want to understand what type of business components these are. And so I'm just going to fly through these slides so that we have more time to kind of talk about other items. But it's asking for, are there new business component or new types of qualifying research expenses that you previously didn't have? What types of business component information there is? Like, is this a formulation? Is this a technique? Is this a process? Is this a product? They want to understand more, and making sure that the taxpayers are doing the right work and not kind of claiming bogus claims. So it's good and bad. But for us, because we've always been doing all of this documentation already, it really is a non-event for Cherry Bekaert. But it is an event in that we now need all of this information by the time of filing, versus, hey, we need to get the numbers done. Once we get the numbers done, now we can collect the qualitative information so that we can wait, so to speak. That waiting will be gone in 2025. I think one of the most important slides that we have is, if you don't have a tax liability, how do you monetize the R&D tax credit? So a lot of what we talked about is really just around federal credits. There are many state credits that are refundable or you can immediately monetize. So one example would be Georgia. If you don't have a Georgia state credit liability, you can actually elect to utilize it against your Georgia payroll tax credits. Georgia payroll taxes and payroll tax withholding. So that's something that allows taxpayers to immediately monetize, especially if they have employees in Georgia. Virginia, for minor credits, are actually refundable, which is great. And what we've seen is recent legislation actually increase the pool for the Virginia minor credit. And we've seen our clients get double the amount of R&D credits that are refundable to them, and that has been very exciting to see. Lastly, right, for the federal, this Marty mentioned earlier, you can get up to $500,000 that you can utilize against payroll tax liabilities for startup companies that allows companies to immediately monetize. So again, there are different ways to look at this, but the credit carries forward to 20 years, and you can use it to offset your taxable gains in the event of a sale. So there are a lot of reasons to be looking at your R&D credits now.
We'll move on.
I think maybe we can skip to
Yeah, we'll
the
skip that and we'll get to the polling question and then we'll move here. Okay, so does your R&D process collect the information necessary to fill out the new form 67, 67, 66, 7, 65, nobody calls it that. The new form 6765. That would be anything that you would normally have in an R&D study, generally speaking, if it's worth what you're paying for, it would have most of that information in there. I think the next topic and is probably the most interesting of all the R&D topics, which is capitalization around 174 and what's going on there. So your R&D process does not have it. Okay, cool. Boom. Here we go. Talk about capitalization of what's known as specified research and experimentation expenditures. The biggest deal to everybody, the thing that's keeping everybody up at night in the R&D world.
Yeah. So the biggest reason this impacts all taxpayers that perform R&D is that your tax bill, at least in the more recent years, is going to look very drastically than before 2022 tax year. In that it's going to be significantly more because you no longer get to timely deduct your research and experimentation costs. It's going to hurt even more in the context of government contractors who get paid to do R&D. Because now, instead of getting to deduct your labor costs, which is your cost of sales, you actually have to recognize that revenue and you have to capitalize, which means you don't get to deduct your expenses. So you're left with kind of what I'm going to call phantom revenue, phantom income that you really don't have to pay for the taxes. Unfortunately, the current tax law is still that all taxpayers have to capitalize and amortize their research and experimentation costs. And we can go into kind of what the definition of research and experimentation costs are, because they are different from the QREs or qualifying research expenses for the credit. It's much more encompassing. And we can definitely jump into that. But the big picture is, even though earlier this year there was a potential bill that was getting passed in the House, but then got shot down in the Senate for going back to timely deducting your domestic research and experimentation costs. Unfortunately, as of right now, the tax regulations are still the requirement to capitalize and amortize your research and experimentation costs. So what I would say and what I would suggest is hope for the best, but plan for the worst. And make sure that you're tax planning so that you make the right estimated payments, so that you can report on your financial statements the right numbers that you need to report, and so that you make the right distributions and that you are planned and aware of kind of your tax situation ahead of time.
That bill that was passed actually for domestic all the way went back to 22 and eliminated the need to do that. I don't think that's going to happen this time with whatever had. That's almost like you need a time machine to go that far in the past, and that would be a compliance nightmare as well. But we shall see what happens.
We shall see. And maybe Marty, we can just jump to the next slide in the interest of time.
Yeah, this is the most interesting one.
Very interesting, right? So when we kind of talked about, you see that little diagram to the right, when we were talking about the R&D credit qualifying research expenses, that's really just a subset of all the costs that you are required to capitalize, which is your 174 specified research and experimentation costs. Because in just the context of wages, right? The R&D credit, you can only look at box 1 W2 wages for R&D activities. This is for 174 purposes or the capitalization purposes, you're looking at gross wages, fringe benefits related to that employee doing work. So it's much more than just W2 box 1 wages. In addition to kind of your supplies costs and your contract research costs, which we know a lot of subcontractors might have to capitalize, your credit eligible expenses for contract research is actually just 65% of the costs, versus you actually have to capitalize 100% of your contract research costs for 174 purposes. So that's another big difference. For the R&D credit, you are only looking at onshore resource costs or costs that are incurred in the US. For capitalization purposes, your offshore research costs are actually capitalized and amortized over 15 years instead of 5 years for your domestic costs. So the cost is much greater than what you would expect when you just look at what your credit eligible expenses are. Lastly, a big chunk would be around your depreciation, your incidental costs to R&D, such as your rent, your utilities, your maybe your some of your G&A costs. So those are things that you should all be looking at when you are looking at your capitalization. One of the key points that we touched on earlier is when you have research and experimentation, it's actually looking at all of your computer software development costs. And again, right, we want to make sure that we're differentiating between what is training, maintenance, data conversion, installation, configuration, production, as opposed to true development design of your product. So that's something that you can utilize to make sure that you are minimizing your 174 costs for capitalization and maximizing it for your credit. So that's something that you want to pay attention to. And honestly, Notice 2023-63 gives a lot of flavor and additional insights before the regulations actually come out to give more guidance around 174. And the last slide around 174, what's most important is if you are getting paid to do R&D, and sorry, Marty, I think it's the next one.
Yep. And we should have done the whole thing just on this slide, because this is the whole biggest deal, I think, for the government contract.
And again, this applies to professional services firms and government contract firms, government contractors the most, because a lot of times what we see is they are getting paid to do R&D. And again, there's that mismatch between your revenue that you're recognizing for tax purposes and then the costs associated with it. So to the extent that you bear economic risk or retain rights to the development, you would actually have to capitalize your research and experimentation costs that are performed under contract. So again, this goes back to if you're currently in the process of negotiating your contract or renegotiating your contract, bring in the tax folks, have them involved so you guys can make sure you're looking at the company as a whole in a holistic approach, because your 174 costs could bring in a significant tax liability. So if you are getting paid and you don't bear the economic risk and it doesn't make sense for you to retain the rights, maybe put in a clause that gives away the rights, right? Because maybe you don't have the ownership to the actual software itself. But maybe some of the language in your contract talks about how the taxpayer or the government contractor retains the IP somehow, right? Even if it doesn't have the rights to the license of software. That would trigger potentially you guys having to capitalize for 174. The tax folks, so that they're also looking at your contracts. If you guys have any questions around this or want a second set of eyes or around your contract analysis and actually impact your R&D credit or your capitalization requirements, let us know. We're happy to look at it.
Okay. Polling question 4. Here's the big reveal. In 22, did your company capitalize your qualified specified research and experimentation expenditures, basically your R&D expenses, in conformity with Section 174? Meaning, did you know about this capitalization? Yes, no, NA, or not sure. I think probably you all knew about it. It's certainly been one of the things we've talked about more than any other. The question is the methodology around it. And even those that did capitalize, we found that after understanding it a bit more, they might have done it a bit differently. So we'll leave it at that. Thank you. Yes and no. Okay. All right, Tim. Big reveal. Let's see if the microphone works, and let's see what's up. Can we hear you? Muted. There we go.
Can you hear me now?
I can hear you now.
Awesome. Yeah, someone needs to research why my audio worked during mic check, but not in the actual thing. Anyway, Inflation Reduction Act. Excited to talk about this. This was a real big deal when it came out in 2022. But I think, kind of the starting point is actually before the Inflation Reduction Act. There was a world of energy credits, it's specifically focused on providing incentives for sustainable clean technologies before the Inflation Reduction Act was passed. That world was largely dominated by large developers and utilities who were putting into service really big wind farms and solar arrays and specialized technologies. What the Inflation Reduction Act did was kind of democratize those credits and spread the opportunities to use them, take advantage of them, and monetize them in a variety of different ways. It expanded the eligible technologies and it juiced them up. It made them much more lucrative. I think the last estimate I saw is that the several $100 billion in costs for the clean energy portion of the Inflation Reduction Act is actually going to exceed $1 trillion over the 10-year core life of the legislation. So there's a lot of money flowing into these technologies through this act right now. But it is interesting that this stuff was around, and now we've got new enhancements, and that's what we're going to focus on today, is some of these really cool ways that you can take advantage of the dollars in this act to whether you're investing in clean energy technologies yourself, maybe your business is looking to offset utility costs, and it's going to do it through rooftop solar or a large solar array, and I think this is going to be the key point of this conversation, if you are a C Corp or if you have passive income of any sort, you can actually kind of indirectly invest in these technologies to offset your tax liability without actually putting anything tangible on your roof, for example. So what does the Inflation Reduction Act tax credit look at? There's some core technologies. What's really interesting too, and we'll talk about this a little bit, this is going to a technology agnostic or technology neutral regime starting in 2025. So most of the technologies that are on this slide are still going to be part of the federal credit structure under the Inflation Reduction Act, but the act is no longer going to look at specifically what is your technology you're putting into service. It's going to say, are you generating electrical energy and are you doing it in a net zero manner? And so you're going to have to provide different types of documentations to show those greenhouse gas emissions rates. But essentially, we're looking at solar, wind, geothermal, nuclear, carbon sequestration, hydrogen, all of those types of green energy technologies. To the extent you're producing electricity and selling it to a third party, or you're investing in the technology itself, there's a potential credit. The other thing that's in here too, and you'll see there at Section 45X at the bottom of the slide, there's also a new credit that was created by the Inflation Reduction Act to provide an incentive for those folks actually manufacturing some of the components that go into this stuff. So if you're making batteries or if you're making solar modules or some of these other technologies, or if you're involved in the mineral acquisitions for these technologies, there's additional credits out there for those types of activities. So I mentioned that the Inflation Reduction Act increased the credit rate. We were actually a phase-out period pre-Inflation Reduction Act where the credit rate for most of these technologies was going to go down to 10% for the investment tax credit. So a lot of these credits are calculated off of what are your qualified dollars that you're investing into the assets you're placing into service. For example, I put a $100,000 solar array. In the old world, pre-IRA, I might have a 10% credit. So I'd get $100,000 in one-to-one federal tax liability offset in that federal tax credit. We now have kind of a base rate of 30%. Some people call the base rate 6%. Some people call it 30%, and I'll explain why that is. To the extent that you exceed a megawatt in capacity of your technology, you're going to have to show prevailing wages were paid during the development or construction of whatever it is you're placing into service in order to get that 30% amount. If you're under that threshold, you'll get the 30% base rate. So you're putting in $1 million worth of assets and you're getting a $300,000 credit. If you don't meet prevailing wages and you're over that megawatt, you'd get 6%. But then there are additional enhancements to these credits that get added on to the credit rate. Meaning, if I source most of my project, and there are different rules about the steel has to be 100%, and there are some interesting, fairly complex notices that we work with our clients on in terms of meeting the domestic content requirements. But if I source my components domestically, I can get an additional 10%. So that 30% goes to 40%. So I put $1 million into service, and now I get a $400,000 credit. There's an additional adder that continues to stack for placing it into an energy community. And there are a few different ways that energy communities can be defined, but there are Department of Energy maps now where you can go and check your location and see if you meet this energy community descriptor. You'll get another 10%. So you can be looking at a 50% credit. There are also a couple of other additional 10 and 20% credits. Theoretically, you could get up to a 70% credit. Generally speaking, that won't happen, but certainly the 30 to 50% range is a typical range that we see. I mentioned this, prevailing wages are a requirement for certain projects. There are also some specific credits that even if you aren't over that megawatt threshold, you'll still need to meet these. These are defined by the Department of Labor. And the way the prevailing wage works is you have to go in, look at every single laborer that touches your project, whether it's the actual contractor or developer or even a subcontractor that's working on that project, classify them by what they're doing and by their geography, get that prevailing wage from the Department of Labor, and then check to make sure that throughout the life cycle of the project, that prevailing wage was paid. There are some cure provisions. So to the extent that you miss your prevailing wage payments during a certain time period, you can go back and pay those wages and then pay an amount to the IRS and the Department of Treasury to cure that and still get your credit. But it is a very important piece to these projects because you will lose a substantial amount of your credit if prevailing wages aren't paid. And the other unique thing to this is in most circumstances, when you're filing for these credits, you put it on a form and you give the IRS information and they give you the credit. And should they audit, you're required to keep your documentation to prove out that you're substantiating what you're claiming on for the credit. In this case, the IRS has affirmative documentation rules that you are tracking this throughout the development of the life cycle of the project, and you're keeping an eye on it. And there isn't an exact amount of time in which you need to continually check these, but the example in the IRS regs that they put out is at least quarterly. So this is an important documentation exercise for folks. The apprenticeship requirements is in addition to the prevailing wage requirements. The apprenticeship requirements require you to have an increasing amount of apprenticeships. I believe going into this year, it's actually at 15% now, and will stay at 15% of your labor hours are filled by apprentices. All right, the key topic here, this is the awesome one, transferability. So this concept has never existed in the federal tax landscape before. There's something similar that's existed in some states. I think Georgia has an entertainment credit that functions a little bit in a similar way where you can move your credit from one taxpayer to another. But the idea here is I can generate a credit that I can't use, but I can still monetize it by transferring it to somebody who can use it. So if we go back again before the Inflation Reduction Act, there was a world in which a lot of the folks who were generating these credits were operating in net operating losses or were already generating a lot of credits, and they didn't have any federal tax liability to offset, so they would have to wait to monetize the credit. And in order to get around that problem, they entered into sophisticated tax equity partnerships, often with large financial institutions, to share those tax attributes so that they could find a way to monetize those, reduce the levelized cost of energy, and make these credits still work for them. The issue with that is these partnerships were very complex. They took a lot of effort, lawyers and CPAs and all sorts of folks involved, and there was still some risk. There were disguised sales issues with the partnerships. There were exit problems. And so when Congress passed the Inflation Reduction Act, part of their look was, how do we reduce the transactional cost of funding these credits and helping people that are doing what we want them to do, putting into service solar panels, for example, monetize them in an efficient manner. And the idea was, well, we'll create a new funding mechanism. It's referred to as transferability. And what it does is it offers the ability to transfer place for these credits where the value of a credit is going up and down in like a trading sense. But there is a marketplace that we'll talk about. It functions more as almost like an eBay, but a one-time movement of the credit to someone who can monetize it in exchange for cash, and there's no federal tax implications for the credit to the two parties involved in the transaction. This is available generally to C corporations, and the reason that is that it is 469 passive income limited, but C corps don't have to worry about that. To the extent you're an individual or you're a flow-through entity like a partnership where the credit would move to an individual, you would need to have passive income that you can offset with the credit in order to monetize it. This is just a list of some of these credits that are available to be transferred. Most of the credits that were altered, modified, or increased by the Inflation Reduction Act can be transferred in this way. But you can see there from carbon capture equipment to a lot of the different renewable technologies that we've talked about. All of those can be used to monetize them through transferability. And once again, this was on the outset slide too, but these are a lot of the different properties that are generating these types of credits. We talked about the investment tax credit a lot. I mentioned the production tax credit. The production tax credit is a similar technology concept, so the same types of technologies, but what's happening there is you're producing the electricity, you're selling it to a third party, and the amount of the credit you're generating is based on the amount of sales of electricity to those third parties. So this actually does matter a little bit in this transferability concept, and I think that'll become apparent. I'm going to walk through a little bit how that works briefly. So to take advantage of this transferability concept, let's say you're a taxpayer with a significant federal tax liability. You have $10 million in federal tax liability, and you want to go purchase credits. You can go to marketplaces or find advisors who have folks that are generating credits and want to sell them. Great, thank you, Marty. Yeah, and what you can do is bid on those credits and say, hey, look, I've got 10 million in liability. You have 10 million in credit. I will give you 90 cents on the dollar. So I'll give you $9 million for your $10 million credit. And it's an arbitrage opportunity. So you can make that $1 million in difference as a permanent benefit to you. But there are some considerations here, right? One is that if the credit is not calculated properly, or if there's an issue under audit, you are also, as the buyer, liable. And that's where my team uses its knowledge and expertise in this area to help our clients look at these credits and make sure they're good credits that are calculated correctly and they're documented properly. And this is where that investment tax credit versus production tax credit comes up a little bit. The investment tax credit is subject to a 5-year recapture, meaning if the person who placed that property into service disposes of that property for any reason during the 5 years, there's a pro rata recapture of that credit where you owe the money back to the IRS. The production tax credit is not subject to that recapture. Once you have sold those credits at the end of the year, you've generated that credit, there's no recapture period. So the price of those credits tends to be a little bit higher in this marketplace, but your risk potential is a little bit lower. Now, the market has also corrected for those types of issues as well. There are insurance products available now for investment tax credits, so the risk is really almost zero in practical terms in these marketplaces. But it's an awesome opportunity. You get an incredible 85 to 90 cent arbitrage benefit on the federal tax dollars that would otherwise go out. But there's an even added benefit, and you'll see at the bottom of this slide, there's also a cash payment deferral. So the IRS has issued regulations on this and said, in the tax year in which you're planning on purchasing credits that you're going to put on your return, stepping into the shoes of the taxpayer who generated them, you can reduce your quarterly estimated payments throughout the year to the IRS by the amount that you expect to use those credits against your liability, which means the cash isn't going out the door in the year in which you're planning on purchasing the credits for. The cash that you will pay for the credit can be timed after that year. So that cash has to move, and you have to receive the credit and close on the transaction by the earliest of either of the two parties' tax filings, which often is 6 to 9 months after the close of the calendar tax year. And so you have an opportunity to not pay your cash taxes throughout the year and your quarterly estimated payments, and then time that as far out as you possibly can. So in addition to just this arbitrage permanent benefit, you also get a cash deferral benefit. It's an excellent opportunity. We're seeing more and more folks taking advantage of this. And you also get to tell the story that you're investing in clean, sustainable technologies because you're purchasing and funding these credits, even though you're not putting the technology into service yourself.
We're going to start.
Muted, Mike.
We're going to start to speed this up a little bit through the next 5 minutes because I hope it's all we have. But have you considered benefiting from any of the credits in the Inflation Reduction Act? Specifically, as Tim was alluding to, maybe I would even ask it, like, have you thought about purchasing credits? And that will mostly apply to the extent you are a C corporation, which not all government contractors are. Probably the majority of this are not. But to the extent you are, you do have the ability, if you have a tax liability, to go out and purchase credits, as Tim was alluding to. If you want to talk about it, please talk to us. We can guide you through that process, I think, fairly quickly, and assess whether there's value and help you reduce that liability. Okay, so cost seg and 179D, we're going to kind of speed through this, and this is just one more thing for government contracts. To the extent you own your real estate, own real estate within your business, and you haven't looked at accelerating the deductions associated with it, we can go back a number of years and look and take much of the building out of 39-year property and place it into quicker depreciable lives. Depending on the year it was placed in service, bonus depreciation may or may not apply. Certain component pieces are subject to quicker depreciation than others. But this has been around for a long time. It continues to be one of the most important things that we see both all taxpayers and government contractors take advantage of, because it has the ability to, from a timing perspective, reduce your taxable income with these accelerated deductions. And in the time of 174 capitalization, that is raising taxable income, this seems to be a very important tool to combat that. The last thing I want to talk about is Section 179D. This was enhanced under the Inflation Reduction Act. This is the, we'll call it like another component piece on the side of cost segregation, but it applies both to building owners and to architecture and engineering firms to the extent work is done on a building to improve its interior lighting, its HVAC, or its overall building envelope. We take a look at and model out the energy efficiency savings that it has compared to a standard that currently is based back in 2007. The maximum deduction associated with this is now north of $5 per square foot, up to the amount you spend on the overall refurb. So it's it used to be $1.88 a square foot. So what we saw beginning in 2023, under the Inflation Reduction Act as it kicked in, 179D became very important both for building owners as an additional tag along to cost seg, but also to architectural and engineering firms who are doing work for government buildings or not-for-profit buildings. They can have those building owners allocate the deduction back to them. So it's a deduction available for both building owners and for architecture and engineering firms who work on those buildings. With that said, we are about 2 minutes in from the end, and that's everything that we really wanted to cover today. We really wanted to focus on government contract specific issues. I really want to also thank Deltek for sponsoring this again today. I will just leave this, like, how did you hear about today's webinar? Final polling question. A, from a Cherry Bekaert tax advisor, an email from Cherry Bekaert, an email from Deltek, a friend or colleague. I question how good of a friend they are if they invited you to this, but we'll see. Or a social media post. We are happy to have had the opportunity today to speak to you. I also did take a look at all the polling questions that were in there today, and I did my best to answer. There were like 4 or 5. I think I answered 2 specifically, and 2 I also suggested you give either me, Tim, or Vivian a call. I put my email address in there. We're more than happy to respond directly. I want to thank everybody because this concludes what we have today. Thanks for joining. We definitely value your feedback. Thanks for taking part in a short survey after this, after you leave. And just a reminder, recordings will be available in about a week. Thank you, everyone, for joining.